We're in a really strange situation right now because the economy is collapsing, but at the same time, the stock market is taking off. So it gets a little bit confusing. I've had a lot of people asking, is now the time to sell? And it's a good question. So by the end of this video, you will know what we're thinking right now, our research firm Macro Ops. And also Strategy Builder Pro, our training program that teaches you how to build a successful investment strategy from zero. That's open right now. It's closing Sunday at midnight. So click the link down below in the description and comments to get started with it today. Because again, the same questions that I'm getting asked right now are what we go over in this training program. So one of them is like, how long do I hold on to these winners? Because that's always the question. You don't know if the stock is going to keep going higher or if you should take your profits right now, especially with this type of situation in the market where there's such a discrepancy between the economy and the prices of stocks. Well, we could talk about what we think is going to happen all day, and it does help a little bit, but more than that, the thing that really helps is having that strategy in place. So if you're following your rules that you put together, regardless of what's happening in the broader market, you're going to be okay, because part of your rules will be when to take profits, when to cut your losses, and that's what's going to continuously make you money over the long term in the stock market. Anyway, you can learn more about that program, so you could either build your own strategy or improve the one that you have just by clicking the link down below in the description and comments. I'll explain more on this page. Now to our research, which you know comes from Macro Ops. So it's easy to forget just how bad the economy is right now, especially when you're looking at the stock market, because you see that and you're like, oh, it must all be good. So let me quickly remind you just how bad it is. 22 million in initial US jobless claims over the last 4 weeks has wiped out the total number of jobs created since the great financial crisis, which was 10 years ago. See, this white line is all the jobs created, and this blue line is how many jobs we just lost. 10 years of progress gone in a flash. The unemployment rate right now is around 16%. Here's another way to look at it. The US initial jobless claims going all the way back to the 1960s. This spike that we've had is so large that it's like incomprehensible, which is probably part of the reason why the stock market is going up, because people just don't understand. But look at this spike compared to all these years. Not even comparable. Or you could look at the US unemployment rate over the last 70 years. So around 10% was the unemployment rate in the great financial crisis, which was the worst crisis in decades. 16% is where the unemployment rate is right now. Already surpassed that old milestone. 20 to 25% unemployment is pretty much on lock within the next 2 months. That's all the way up here. And in the Great Depression, unemployment hit a high of 24%. So those are the types of numbers we're looking at. So you can look at some of the data from the recent surveys of small businesses. And small businesses employ 50% of American workers. They're extremely important to the economy. 43% of those businesses are temporarily closed right now, and 1.8% are already permanently closed. Employment has fallen by 40%, and this is 1.8 so far. As the days go on, more and more companies are going to shutter their doors for good. And the reason why is because a lot of these firms only have a little bit of cash on hand, and costs don't just go away once you close your shop. There are things that you have to keep paying, like rent. So to survive, they're already doing drastic things like dramatically cutting expenses, taking on additional debt, or even declaring bankruptcy. The median business has more than $10,000 in monthly expenses and less than 1 month of cash on hand. 75% state that they only have enough cash to cover 2 months of expenses or less. And in the industries that are directly exposed, like restaurants, tourism, personal services, they don't think they're going to stay in business if the crisis lasts longer than 4 months. That's why this 1.8% number, it's only going to grow as each day passes. So this is a shock to American small firms that hasn't been seen since the 1930s, which was the Great Depression. Right now, roughly 1/3 of Bank of America's small business loans are in deferral, which is huge. And whether or not they eventually get paid back, well, that depends on how long this epidemic lasts, which still no one has any idea. The Financial Times' Martin Wolf explained how bad it is. So in the latest World Economic Outlook, the IMF called what's happening now the Great Lockdown. He prefers to call it the Great Shutdown, though, because this phrase captures the reality that the global economy would be collapsing even if policymakers were not imposing lockdowns. And they might stay in collapse even after the lockdowns end. Whatever you want to call it, this is the biggest crisis that the world has confronted since the Second World War. And it's the biggest economic disaster since the Depression of the 1930s. And this is happening in a moment where there's huge divisions among the great powers in the world, and the incompetence in the government is at terrifying proportions. So we'll get through this, but what is life going to look like afterwards? The IMF forecast now suggests that global output per head will contract by 4.2% this year, which is way more than the 1.6% it recorded in 2009, again during the great financial crisis. 90% of all countries will experience negative growth in real GDP per head this year, against 62% in 2009. Back then, China's robust expansion helped cushion the blow, but that's not there this time. So however way you slice it, this is way worse than 2009. So considering this, it's ridiculous that Wall Street is saying that, the bear market is over. Goldman Sachs says we're unlikely to make new lows. Morgan Stanley says pullback should be bought. JP Morgan, all-time highs next year. Piper Sandler, bear market has concluded. And of course, they're all getting bullish after the S&P has rallied 30% off its lows. But what were they saying just 2 weeks ago? Yeah, they thought the sky was falling too. Michael Pettis had a good explanation of just how fragile the economy is. And he basically explains what we've talked about before in these videos, how over leveraged the economy is and how that can really work against you during a time like this. So he says when an economy goes through many years of rising real estate and asset prices, surging debt, and loose monetary conditions, business balance sheets tend to get structured in highly speculative ways that effectively bet on more of the same. So for example, businesses that leverage up, the ones that are taking on more real estate than they actually need, and basically make the liability side of their balance sheet more risky, because debt is liability, right? They do all that on the assumption that future conditions will be more of the same. Like they assume easy money will be here forever, interest rates will be super low, the economy will keep moving forward, and their short-term bet that they're making now does outperform the businesses who manage their balance sheets more prudently, who are not taking all the debt on, who are not over leveraging, who are being conservative. This is what Pettis calls inverted balance sheets, because you end up having more debt than assets. So as a result, over many years, because this works, in a bull market, and a bull market is extended like 10 years or more, as we've just seen, the less prudent, risky companies that are taking on all this debt, they're going to end up displacing the other companies that were more conservative. Or if those other companies that are conservative want to survive, then they're going to adopt riskier balance sheets too. And this goes back to what we were talking about before, like when I was complaining about these stupid airlines getting bailouts. I was saying how executives weren't being responsible, they weren't being conservative enough to last a storm like this. But in fact, what happens is that they have to do all the buybacks, they have to over leverage because they're being rated by the market and shareholders. And if the shareholders are rewarding the more risky people, and just the system in general is rewarding more risky businesses, then either you become more risky too, or you get washed out, you fail. Which is why I think the government should have a heavier hand in some of these areas, because capitalism left to itself like this, it just eats itself, it destroys itself. So you need rules of play. But in a bull market leveraging period, those rules might not be there, and this is what happens. So over time, the whole economy shifts towards riskier balance sheets, because that becomes the name of the game. It's the business equivalent of getting up and dancing as long as the music is playing. So this is a problem pretty much everywhere, not just like the US. It's especially a problem in China, where decades of artificially high growth, soaring real estate prices, excess liquidity, and surging debt have transformed the balance sheet structures of nearly all businesses. And this is what I talk about when I say that China is a house of cards, because they are the best at that debt-fueled growth. So these inverted balance sheets, as he calls them, where you have way too much debt, they're highly pro-cyclical. So as long as conditions are good, it actually works out pretty well, because businesses are able to boost their profits a lot, even with their balance sheets holding a bunch of speculative activity. So yeah, it works well in a bull market. But when the underlying conditions reverse, so we head into something like this, a bear market, instead of higher than expected profits, these businesses start suffering higher than expected losses, with their lower revenues being reinforced by rapidly rising borrowing costs, and if the risk of insolvency rises, by rising financial distress costs. So these economies and businesses that have a lot of debt and an inverted balance sheet, they tend to surprise on the upside when conditions are good, where they develop a reputation for smart management. Oh, they're so great. And then they destroy this reputation when the conditions reverse. You can call it Enron syndrome. So global leverage is the highest it's ever been, both from a private and public standpoint. The global balance sheet is inverted with a capital I. And basically the whole point of what we just went over is that debt and leverage, it cuts both ways. So if you want to get risky during the good times, which you might have to because of the system, yeah, you can outperform, but then your business isn't very robust. So when the bad times come, you collapse. Which again, another example we talked about are these global supply chains not able to handle what just happened because they're just leveraging to the hilt. There's not enough slack in the system. Because of perverse incentives and the messed up system, you don't get rewarded for any slack. You don't get rewarded for being prudent. So because of the way our balance sheets are and how leveraged we are, the financial stress is non-linear. So conditions can deteriorate much more rapidly than they can improve. So what's about to happen with this unwind that we're going to go through is that the real value of all assets is going to be questioned. What are businesses, real estate, artwork, bananas, duct taped on walls, what are they really worth if our balance sheets begin to unwind, if borrowing costs skyrocket, and if there's no liquidity and lending dries up? Basically, when the Kool-Aid at the party is taken away and everyone is sobering up, what's about to happen? When the tide goes out, who's wearing pants? No one knows until we hit it, which we are about to. And if you talk to any business operator from small to large, or any VC or private equity guy who all have their fingers on the pulse of their portfolio companies, they're scared. They're really scared. And that's what's crazy, the contrast between the fear of those actually operating on the front lines who actually have businesses, skin in the game, and then the Wall Street and the analysts saying, oh yeah, the bottom's in. The difference has never been so stark. There's a Grand Canyon-wide disconnect between financial markets and the real economy right now. But in a major regime change like we're going through right now, that's kind of what happens. Majority of people are still operating off the old rules with old assumptions, thinking it's going to go back to the same. But they don't realize that we're in a new paradigm, playing a new game with new rules. Now, one of the reasons we've had the stock market be inflated like it is, and why it's being detached from the real economy, is because of our game masters, our central banks. They have done an incredible job providing a bullish counterbalance to what's actually happening. The size of the collective monetary injections that we're getting will dwarf anything that's been done before, and we're likely just getting started. Look at this balance sheet, shooting up. Powell loves printing. And what's interesting to look at is China, because they're facing their highest levels of unemployment in decades. So it appears that the CCP is shifting gears from only doing targeted measures, because they've been trying to deleverage their economy, to now calling for broad-based economic support. This is a very important development, because China is still the biggest driver of the macro picture. And what happens there will either prolong this cycle or stop it dead in its tracks. They're the biggest liquidity provider. And the latest with what they're doing and how they're reacting to this means that they're likely kicking the can down the road, meaning they're going to paper over all their problems with all this free money. But it's still too early to see. What you got to look for is accelerating China M1 growth, which is their money supply. And we're keeping an eye on that for that to happen. Excavator sales by Chinese OEMs just hit record levels, which suggests that they're turning back to their old growth levers of building unneeded and unproductive infrastructure in mass. You know, all those ghost cities that you hear about in China? Well, it's a good way to inflate your GDP and keep jobs, right? Unproductive building, but building nonetheless. So if that's the case, we should expect China's Q2 GDP to be significantly higher than expected. And because they're doing all this building, they'll put a nice floor under commodities, because they end up buying the most amount of commodities. Commodities markets around the world are dependent on them. Morgan Stanley recently projected that China will soon see 80 to 100 million workers out of a job. That's a lot of people with a lot of idle time. And the CCP knows that they want their people working, because if they're not working, then they're thinking about, our government just, suppresses us nonstop. Maybe we don't like communism. Maybe Xi Jinping is evil. No, can't have any of that. Got to keep the house of cards up. So that's why they might just go back to stimulating. And that would be very bullish over the short term for the global markets, especially for commodities, emerging markets, shippers, and gold. But even so, still, no one knows what's going to happen with this virus. Morgan Stanley's lead biotech analyst, Matt Harrison, had something to say about it. He said it's been striking how investors have reacted to the first signs that new cases in New York are starting to stabilize. That's great to have some optimism, but the actual outbreak is far from over. Recovering from this first period outbreak is just the beginning and not the end. The path to reopening the economy fully is going to be a long road. It's going to require turning on and off various forms of social distancing and lockdowns. And it's only going to come to an end when vaccines are finally available, which won't be until the spring of 2021 at the earliest. That's a long time. So initial reopening should come mid to late May, but it's not going to be a normal reopening. A large number of workers will not be able to go back to work until a vaccine is available, because we need herd immunity before, we could get back to normal. And large venues like sports stadiums, concerts, theme parks, they're going to have to remain shut or cap their attendance at 10 to 25% of prior levels. So Morgan Stanley's US economists have revised their US forecast for a return to pre-virus levels not until Q4 of 2021. That's a long time. Yeah, there is a chance that Gilead produced something, with all that news that came out about it, but it's not the highest probability that that's going to save us. But there are also signs that a lot of us have already had it and are just asymptomatic. So if that's true, then we might be a lot closer to herd immunity than we thought. So that might be some good news. All in all, no one knows anything. So as Walter Deemer said, the only thing I have strong conviction about right now is that nobody should have strong conviction about anything right now. Okay, now that we know how bad the economy is, let's look at the stock market. So the retrace price that we're having right now, this bullish trend, is well within the normal range of bear market rallies. So our original target of 3,000 to 3,100 on the SPX should be hit within the next week or two. But you can see right here, this little red line is the 50-day moving average, and it's coinciding with that level. That's a lot of overhead supply. It's a huge resistance. So once we hit that level, we'll likely go sideways to lower. So you can see right here that the general index is in a broadening top pattern. So we should expect an extended range of volatile sideways chop. That means up and down, but sideways over the long term with a downward bias, because we think there is going to be a second low. This bear market is not over. Update on gold, which we talked about in a recent video. The yellow metal is testing its inverted head and shoulders neckline. If we see a close between the 1650 level, then it's not ready to take off yet. So Alex is going to pull his position and then wait for the next setup. And then we got tankers, which we talked about previously too. The longer term charts of the tankers still look really good. So in the macro ops portfolio, we got a position in TNK. It's in a clear uptrend, and right now it's coiling in a bullish wedge. So close well below this wedge, that will nullify the bull case. But if this does take off, there's incredible upside, as we explained in that previous video. Tanker rates are making decade highs right now. Vessel prices are trading up and to the right and are near decade highs as well. And oil prices continue to collapse. So things are looking good for this tanker thesis. Now, if you haven't already, make sure you check out Strategy Builder Pro. There's a link down below in the description and comments. Do it now, do it today, because we are closing it Sunday at midnight. And really, if you want to make sure your investment strategy is in place to survive this regime change, to survive this second bottom that we're about to have, then check out the training program so you could get everything in place. So you know when to buy, when to sell, how to control your risk, all those things that you need to be successful over the long term in the market. Click those links, definitely check it out. And if you haven't already, make sure you subscribe to this channel. Do that, and I will see you in the next video. Stay fallible out there. Bye.